there are 4 key principles that I go by when I choose stocks. I also have a set of rules that I follow. If you haven't checked out my Smart Money rules yet, go over to my bio, click on that link, and you will see the questions that I ask myself before I buy any stock. However, all of those questions are based on 4 key principles. Now, the 4 key principles that I follow are actually pretty widely known. However, they're not really talked about in depth the way I'm going to talk to you about them today. So 4 key principles, here we go. Number 1, I check the fundamentals of the company that I want to buy stock in. If you don't know this already, when you buy stock, you are actually buying pieces of a company. So before you buy those pieces of a company, you want to do research on the company. And you can do this just by going to the company's website. And usually there will be a tab towards the bottom of the website that says investor relations or for investors or something like that. It's usually a little hidden, so sometimes you have to dig for it. But there is usually an annual report that you want to look through. Now, these annual reports can be long and daunting and loaded with information. So when you're looking through these reports, the most important things that you want to look for is, number 1, is this company growing? How do the sales look for this company? Are they increasing year over year? Did they increase this November or this past November compared to last year's November? You should see a company increasing its sales by about 20% at least on an annual basis. Sometimes there are utility companies that are only increasing about 8%, 10%, and that's normal because typically prices for companies such as utility companies are actually set by the government. So you won't see a huge increase in that. And let me just say also that utility companies are usually a safer bet. So you want to usually hold those in market downturns. The other thing you want to look for is earnings per share to sales to profit ratio. So obviously, if you're investing in a company, you want to see that they're making a lot of profit. For example, Apple has a lot of cash because they're a very profitable company. So you want to look for companies that have a lot of cash. Now, a lot of larger companies are actually in debt. So debt isn't such a bad thing. Debt's actually it's pretty normal for large companies. You just want to make sure that they are actually making money, increasing their sales so that they can pay off that debt in a given amount of time. The second principle I follow is institutional shareholders, also known as institutional sponsorship. Now, you want to make sure the bigger institutions, the bigger hedge funds, the bigger banks are actually owning shares of this company. And one way that you can do that is you can go over to Yahoo Finance, you can look up the company, usually under the ticker symbol, and you can find on their company profile which banks hold the most amount of shares and how many shares that they hold. So that is key principle number 2. Key principle number 3. Now, this is something that all of the stock market gurus make way more complicated than they need to. But the third principle that I follow is looking at the chart and making sure the technicals are in order. This is going to tell you when to buy a stock and when to sell a stock. Now, all you really have to do when you're doing this research is look for support levels and resistance levels. Support levels are typically where a stock has come down to on the chart but hasn't broken below. And resistance level is where a stock or the line on the stock chart keeps hitting up against but hasn't broken above. So sometimes you'll hear on the news, Apple has broken above the 230 threshold, meaning it was stuck or coiling around that price point for a long time, and then it finally broke through, which usually attracts more investors. However, the key is getting in before it does that. But also the key is getting out before a stock drops below the resistance level. The other things that I follow when it comes to technicals is I follow the 50-day moving average and the 200-day moving average. Typically, when you see the 50-day moving average crossing above the 200-day moving average, that is a huge bullish signal, meaning that stock price is usually going to keep going up. So you want to follow those stocks. Now, when you see the opposite, which is the 50-day moving average crossing below the 200-day moving average, that's a bearish signal, meaning that stock price is going to keep dropping and you're going to want to get out of that stock. Another principle that I follow in terms of technicals when buying stocks is to make sure that the volume on the bottom of the stock chart is increasing. If you see stagnant volume or you see volume getting lower and lower and lower, it usually means that there's not a lot of people buying that stock, which means you probably shouldn't either. Sometimes you will see a lot of low volume on a stock and you'll see the stock going up a lot. Be careful when buying those stocks because there's usually a scam behind that and you want to stay far away from that. Now, if you're a risky investor and you want to jump in, grab a profit, a quick profit, and then get out, by all means, go ahead. I know I've done that plenty of times. It is risky. So if you are going to do something like that, I suggest not holding it for very long. Key principle number 4 that I follow when I am buying stocks. I pay attention to which sector that stock belongs to. Now, there's 11 different sectors in the stock market, and typically everything in the stock market belongs to a sector or an industry. So you have, for example, consumer discretionary, you have materials, you have industrials, you have real estate. Those are just 4. You also have the technology sector. And so you want to look up the sector of the stock that you are about to buy, because this is going to help you diversify your portfolio, because you don't want a ton of stocks in just the technology sector, because chances are if something bad happens in the tech sector, all of your stocks are going to go down. It's not going to be just one. So the main way that we talk about diversifying your portfolio at Market Start is by sectors. So you want your different stocks to be part of different sectors, and then that will give you a well-balanced portfolio. Thank you guys so much for watching. My name's Jody Jacobs. If you haven't already, click that subscribe button for more stock market tips on growing your portfolio, and we'll see you in the next video.